In this segment, we'll talk about venture capital and hedge funds. First, venture capital investing. As a basic definition, when we talk about venture capital investing, we are talking about private equity investment in a business venture. So take this example. Let's say that you have a pile of cash, and if you use these funds to invest in small businesses, so either startups or companies at small companies in various stages that I'll talk about shortly. So you take your money and invest in these businesses, and you might have different percentage stakes in each one of these businesses. This is referred to as venture capital investing. So in my simplistic example, it is a given investor who's directly putting money into these various companies and taking an equity stake. What happens more often is that we have this venture capital fund, and what investors, generally wealthy investors, so investors put their money in this venture capital fund, and obviously this venture capital fund is run by a fund manager who has expertise at identifying successful small companies that have a lot of potential. So the money that they collect, and in this venture capital fund, sometimes the fund manager or the sponsor of the fund might have their money also included in this fund, and then this money is used to invest in and fund companies. And then obviously as these companies grow and become better, then the returns go back to the investors. So that is fairly simplistic and essentially what you need to know at our current level. The next point is that obviously these investments in startups or small companies can be made at various stages of a company's life cycle. The most basic kind of investment, or the earliest possible investment, is a seed stage investment. This is described well on page 214 of the curriculum, and I know I'm not adding tremendous value here, but I'm simply going to read what the curriculum says because I think it's nicely and succinctly put in the curriculum. So when we talk about seed stage, the curriculum says that seed stage financing is capital provided for a business idea. The capital generally supports product development and market research. So essentially here, this is the earlier stage, and we are putting money in to the whole idea development process. The next is early stage. So early stage financing is capital provided for companies moving into operation and before commercial manufacturing and sales have occurred, and this has two sub-stages, startup and first stage. Startup stage is in the startup stage, we have capital provided for companies just moving into operation but without any commercial product or service sales. The capital generally supports development and initial marketing. And then first stage financing is capital provided to initial commercial manufacturing and sales. Formative stage really refers to either one of these two stages. So if we are saying that we are doing formative stage financing, that means we are providing money in one of these stages. And then later stage financing is capital provided after commercial manufacturing and sales have begun but before any IPO. So you can say that this is before an initial public offering. And then within later stage we can have second stage, third stage, and mezzanine. Second stage financing refers to capital used for initial expansion of a company already producing and selling a product but perhaps not yet profitably. And then third stage financing is capital provided for major expansion such as physical plant expansion, product improvement, or major marketing campaign. And finally, mezzanine financing, sometimes also called bridge financing. So mezzanine financing is capital provided to prepare for the step of going public and represents the bridge between the expanding company and the initial public offering. Next, what are the characteristics of venture capital investment? As you can imagine, and this investment is fairly illiquid. So if you put your money into a small company and you are waiting for it to grow, then obviously you can't just decide to take your money out at market value. Your money will be locked in for a number of years. Hence, this is a illiquid investment. You need to have a long-term investment horizon. That's obvious. Difficulty in valuation, we will talk about this later, but when you are talking about a startup, then how do you value the startup? Clearly it is difficult because we don't have comparables, we don't necessarily have any earnings, so valuation is difficult. Data is limited because obviously from limited data from two angles. One, the company that you are trying to value has not been around for a while, and as mentioned earlier, there might not be sufficient comparable data. Another issue is entrepreneurial and management mismatch. What this refers to is the simple fact that good entrepreneurs might not necessarily be good managers. So you might have entrepreneurs who are great at coming up with ideas and creating a small company based on that idea. But if the idea is successful and the company becomes larger, then those entrepreneurs might not have the management skill to keep the company expanding or to be successful once the company has attained some basic size. Finally, as alluded to earlier, performance management is difficult. And what does this mean? Let's say that you are trying to evaluate a venture capital fund which has made investments, several investments. So for simplicity, we'll just say that they've invested in 3 companies. Now obviously, to figure out how this venture capital fund is doing year on year, we need to understand how the value of these underlying companies, how these values have changed. And if it is difficult to figure out how to value these companies, then obviously it is difficult to measure the performance of the venture capital fund. Secondly, there are no real meaningful benchmarks in this industry. So even if you were to figure out some sort of performance, you can't figure out how that you can't really compare that performance with a benchmark. And finally, given that the investment horizon is long term, so venture capital funds might have, say, a 5-year life, and over the 5 years, since it's difficult to value, then obviously from year on year you can't really tell how the venture capital fund is doing. And to just contrast this with a simple equity based fund, there you can obviously look at the returns every year and look at how the equity fund is doing every year and determine whether it's meeting your expectations or not. But clearly with VC funds it is much harder. Venture capital valuation is not easy, and that's primarily because of the risks and uncertainties involved, but nevertheless we will try and give it a shot. I am going to base this discussion on example 5 in the curriculum, and from an exam perspective I think this is quite important. The procedure that we will use is as follows. We will try to value a small startup, and the way we will value it is, first we'll try to determine what is the expected payoff if this startup is successful. So we'll say that we are investing money at time 0 and we want to find the value at time 0. So the first thing we need to say is that if the firm is successful, what will the value be? Let's just pick a number right now of, say, 10 million. And then with this 10 million, if the company is successful, when to exit successfully? So when will we get this 10 million? So let's say that this is after 5 years. And then we also need to determine what is the probability that we are going to be successful. So we are going to use these factors, and then we are also going to use the initial investment as well as an appropriate discount factor to come up with the value of this company. Now, From the curriculum, the example is as follows. This, by the way, is example 5 on page 217. So we have a situation where we are considering a investment at time 0 of $1 million, and this particular investment, the expected payoff is 16 million after 7 years. So at the end of 7 years, so at year 7, we have an expected payoff of 16 million. However, we are obviously not sure that the company will be successful, and the data given to us is that for each one of these years, year 1, year 2, etc., we are given a failure probability. So we are given this failure probability for year 1 is 0.25, for year 2 is 0.22, for year 3 is 0.20, and then it continues to be 0.20 till year 7. Now, the way we approach this problem, the first thing that we need to do is determine what is the probability of success. And the way we do that is we basically use the basic rules of probability. So in year 1, the probability of success is 0.75, and we essentially need a situation where we have success 7 times. So if year 1 probability of success is 0.75, in year 2 notice that it is 0.78, and then in year 3 the probability of success is 0.8. so that's 1 minus the probability of failure. That gives us the probability of success equal to 0.8, and then we have 0.8 5 times, because this goes on 5 times, 0.2 and then again 0.2 for year 4 all the way till year 7. So if we multiply this out, we get 0.192. So the probability of success, in other words, the probability of actually getting the $16 million after 7 years is 0.192. Next, we need to figure out the NPV of this project if it is successful. So if we do go all the way through and we get our 16 million, then the NPV of the project is minus 1 million plus 16 million divided by 1.18 to the power of 7. Where did this 1.18 come from? We are actually given in the problem that the cost of equity here is 18%, and don't worry about exactly how we derive this 18%. You can assume that the problem that you will have to solve will generally give you this required rate of return. So the NPV, if the project is successful, is equal to minus 1 plus 16 over 1.18 to the power of 7. All we've done here is taken the 16 million and discounted it back to time 0. So this NPV turns out to be 4.02 million. Now, what is the NPV if the project fails? So if the project fails, then we spend the 1 million and don't get any returns. So the NPV then is simply minus 1 million. Given the NPV of success and NPV of failure, we now need to find the expected value based on probabilities. So the expected value is equal to the 4.02 million times the probability of success, which is this. So 4.02 into 0.192 plus the NPV if we fail, which is minus 1, into the probability of failure, which is fairly high, 0.808. 0.808 is 1 minus the probability of success. So that's the probability of success. 0.808 is the probability of failure. So the overall expected value turns out to be minus 36,160. So Here obviously what we are getting is a negative NPV, and hence it does not make sense to do this project. So I think from an exam perspective this is important. When I took the exam I had a problem very similar to this one, so I will summarize it very briefly. The first thing that we do is figure out what's our payoff if we are successful. That was the 16 million. So this was the 16 million. We then figured out when to exit, and that was given. That was 7 years. What is the probability of failure? So obviously we need to know both the probability of success and the probability of failure. So we figured that out. Probability of failure was 0.808 and probability of success was 0.192, and then we figured out the NPV if we are successful, the NPV if we fail, and then use the probabilities to come up with the expected value. If the expected value is negative, then it does not make sense to do this project. If the expected value is positive, then it makes sense to do this project. Next we'll talk about hedge funds. Now unfortunately there is no single comprehensive definition that encompasses all hedge funds, but if we were to identify one common theme, it would be that hedge funds seek absolute return. Now this actually is a very important term, because when you talk about your regular stock funds or bond funds, generally those funds are evaluated based on a return relative to a benchmark. So if for example you have fund manager A and his return last year was 15%. To figure out whether fund manager A did well or not, you will have to compare this 15% with the benchmark. So if this fund manager was basically investing in US equities, then probably an appropriate benchmark would be the S&P 500 index. And to determine whether he did well or not, we would have to compare this number with the S&P 500. So if S&P 500 had returned 20% in the same period, then we would say that the fund manager did badly. Now if for example in the year before that the fund manager had a return of -5%, but S&P had returned -20%, then even though we have a negative return here, we would say that the fund manager did well because he did better than the S&P 500. Now this is the way typically most equity funds are measured relative to a benchmark, but investors actually are more concerned with absolute returns. So if you ask an investor whether he would prefer the 15% or the -5%, most investors would pick 15% any day, because they are not as concerned with beating a benchmark. They are more concerned with the sort of return that they are getting, and it is because of this reason that hedge funds have become fairly popular, because they are striving to give an absolute return regardless of what happens in the market. Now how do hedge funds generate or try to generate this absolute return? They use several investment strategies which can be quite different from each other, and we will talk about these different possible strategies on the next slide. In terms of the structure of hedge funds, most of them are organized as either limited partnerships, limited liability companies, or offshore corporations. In the US, they are generally created as limited partnerships, and this structure essentially allows fund managers to take any sort of position in the underlying investment. So they can take long positions, short positions, they can use derivatives, etc. And obviously hedge fund managers want to have as much flexibility as they can. And the way hedge funds are structured and organized, they are generally exempt from SEC regulation. In terms of the fee structure, generally hedge funds charge a flat fee plus a performance-based fee. So for example, a hedge fund will say that they will charge a 1% fee based on the total assets under management, and then a performance-based fee would mean something like, if we beat the risk-free rate by a certain percent, then let's say so this might be something like 20% of the return above the risk-free rate. So obviously here the incentive for the fund manager is to try and generate a high return above the risk-free rate, because most of his return is coming from, or most of his income is coming from being able to generate a return above the risk-free rate. As mentioned earlier, there are many possible strategies that can be used by hedge funds, but here are a few strategies that level 1 candidates should be aware of. One is called a long-short strategy, and basically this means that the fund manager can take both long positions and short positions, and essentially what the manager is looking to do is benefit whether the market goes up or down. So for example, if a manager is generally bearish about the stock market, then he might end up taking more short positions, and if in general he is bullish, then he might have more long positions. A market neutral fund generally wants to have a net zero exposure to the market. So essentially what the fund manager will try to do is pick overpriced and underpriced securities, but try and ensure that equal dollar value is long and an equal dollar value is short. Global macro funds, they basically place a bet on some macro factor such as interest rates. So for example, if the fund manager is betting that interest rates are going to go down, then he might have a overweight position or a long position in several longer term bonds. Typically these funds tend to be highly leveraged. Event driven funds place a bet on events related to either a specific company or specific stocks. And again, I want to emphasize that these 4 strategies listed over here are simply a subset. There are many other strategies, and within these 4 there can be several sub strategies. So there will be more on this in level 2. Right now you simply need to recognize that there is a whole range of possible strategies that can be used by hedge funds. Next, let's understand fund of funds investing, and this name is pretty descriptive, because what this is essentially saying is that we can create a fund of funds. So you can have several investors who might not have the funds to invest in hedge funds. Hedge funds, by the way, typically require large investments of at least $100,000. So you can have several investors pool their money, and then this represents the fund of funds, because this fund of funds will have a manager, and this manager is then going to identify several hedge funds to invest in. So this pooled money in the fund of funds is then invested in different hedge funds. Now, what is the advantage of this approach? There are actually several advantages. One I have already alluded to, where if a given investor does not have, say, the minimum of 100,000 to invest in a given hedge fund, let's say that he can only invest 50,000. So this 50,000 can go into the fund of funds, and then he can get a piece of this hedge fund. Let's say another hedge fund is closed to new investors, but still open to funds that exist in this fund of funds. So secondly, investors can get access to those sorts of hedge funds which are closed to new investors. Third, investors get diversification across a whole group of hedge funds. And finally, investors have this expert hedge fund manager who can do some due diligence before deciding which hedge funds to invest in. In terms of drawbacks, obviously the fees are higher, because investors are now not only paying the fees of these hedge funds down here, but they also need to pay the fee of the fund of funds manager. Performance means that most hedge fund managers select which hedge funds to invest in based on past performance, and as you will see on the subsequent slides, there are several biases in terms of reported performance numbers, and it is possible that the hedge fund manager is misguided by those biases. And finally, given that investors are paying a higher fee, that is one factor that reduces expected returns, but the other larger factor is that even though diversification is good, but diversification across different hedge funds will also lower expected returns. So clearly, even though fund of funds are becoming more popular, but as you can see here, it's a mixed bag. Several benefits, but also a few drawbacks. And I have gone through these quickly. In terms of the exam, as long as you have a one-line understanding of every term that you see on this slide, you are in good shape. Now let's talk about the risks of hedge funds. Number one, leverage. Most hedge funds use leverage. This doesn't mean that leverage is a requirement for hedge funds. It simply means that it's a tool that is used quite often. Now, in general, hedge fund leverage ratios range somewhere from 2 to 1 all the way to 10 to 1. So this means that for 1 unit of equity, we use 2 units of leverage. Here we mean for 1 unit of equity, we are using 10 units of leverage. Now, leverage can also go up quite a lot. There are funds that might have leverage of 100 to 1 and so on. From an investor perspective, what we should be looking at is the leverage of a given hedge fund compared to historical averages or compared to other hedge funds that have similar strategies. Now, some of the other more common risks, one is liquidity risk. This is obvious because many of the underlying instruments in a hedge fund portfolio might be relatively less liquid, and since they are less liquid, then the overall hedge fund faces liquidity risk. Now, pricing risk is again related because if we are dealing with securities or investments that are relatively less liquid, then obviously determining their correct price can be difficult. Counterparty risk is because most of the underlying investments or instruments are generally over the counter, so the hedge fund might be interacting with brokers or dealers, especially dealers in the over the counter market, and there is a risk that the counterparty, which is typically a dealer, there is a risk that the dealer might default. Short squeeze risk means that if the hedge fund has several short positions and if the prices of the assets start going up, then lots of people will be trying to buy to cover their short positions, and if a lot of buying is taking place, then the prices will go up even further, hurting the short position. Financing squeeze happens when there is a high degree of leverage in a given fund. So if there is high leverage and let's say that the fund receives margin calls or needs to raise more funds for some reason, then if the fund is already heavily leveraged, then the cost of raising new funds can become exorbitant, and that is referred to as a financing squeeze. So now let's talk about hedge fund indices or indexes. Now there are several important, or actually there's one core point here. The core point is that information about hedge funds that are in a given index has to be obtained directly from the hedge funds or from intermediaries that specialize in hedge funds. The point being this: unlike stocks where the stock data is publicly available, hedge fund data is not publicly available and needs to be obtained from hedge fund managers, and it is up to the discretion of the hedge fund manager to provide their information. This is going to be discussed on the next slide when we talk about biases. Hedge fund indices can either be equal weighted or weighted by assets under management. The reason equal weighting is used at times because hedge funds don't always disclose what assets they have under management and in what ratio. But when that information is available, then it makes more sense to weight based on assets under management. A major issue when it comes to hedge fund indices is that there are no performance presentation standards in the hedge fund industry. So different hedge funds might be using different standards or different metrics to report their performance, and hence putting together the data from different hedge funds can be pretty difficult. Now this is important from an exam perspective. When we are looking at hedge fund data, especially performance data or the data related to hedge fund indices, there are several biases that we need to be aware of. The critical ones are listed in the top half of this slide. One is self-selection bias. As alluded to earlier, the disclosure of hedge fund data is optional. So obviously hedge fund managers who are doing well are more likely to give their hedge fund data, and hence there is a self-selection bias where there will be a upward bias in terms of performance. Backfilling bias is related. So since the best performing fund managers will give their data, so they will give their track record, which is going to be relatively positive. So when we look at hedge fund databases, the track record that we will see in there will reflect the track record of the hedge funds that are performing well. Survivorship bias implies that if we take a snapshot, so at a given point in time we look at the funds in a hedge fund database. So let's look at it this way. Let's say that it is currently 2011 and we have about 5 hedge funds in the database. Now if this database had been created in 2005 and at that time we, let's say, had 20 hedge funds, then out of these 20 hedge funds, the 15 hedge funds that didn't perform well have dropped out, and we are left with the top 5. And we look at the return of the top 5, and let's say the return of the top 5 is 25%. Now it would be misleading to think that this 25% is representative of the returns of hedge funds, because we are now only left with the best hedge funds, and secondly, who knows which of these funds will survive in the future. So this bias of relatively high returns, because we are only looking at the funds that have survived, and the funds that have survived are typically the best funds. So because of the survivorship bias, again there will be an upward bias in the performance results. Other biases: smoothed pricing of infrequently traded assets. So as mentioned earlier, many of the assets that would be contained in a hedge fund are traded infrequently, and if they are traded infrequently, that means that we are generally going to smooth out pricing and take average prices and so on, which means that there is going to be a downward bias in terms of the standard deviation or the variability of the hedge fund returns. So again, downward bias in the risk indicator. Many hedge funds use option-like strategies where the upside return is limited and the downside is unlimited, and using a simple measure of standard deviation is misleading over here. And finally, you need to be aware of that the fee structure in most hedge funds is going to create problems. Why? Because if you recall, many hedge funds have a flat fee of say 1% and then a performance based fee, where the hedge fund manager gets compensated for say beating the risk-free rate by a certain amount. Now there is an incentive for the fund manager to take extra risk, because if he does not beat the risk-free rate, then there isn't really a penalty. So he might take extra risk because he benefits a lot by beating the risk-free rate, but does not lose if he misses or falls below the risk-free rate. So this might encourage gaming on the part of the hedge fund manager. Investors need to be aware of that. Now here I think is a classic example of what you might see on the exam. The average return for a hedge fund index is overstated and or understated. Now, as you've seen, based on things like the survivorship bias and the backfill bias, the average return for the hedge fund index is going to be overstated. What about the standard deviation for the hedge fund index? Now, given the factors that I just talked about, such as the pricing being smoothed for underlying assets that are not traded as often, so because of these reasons, the riskiness of a typical hedge fund index will be understated. So the correct answer here is B. If I were to bet on the sort of question that would show up related to hedge funds, I would bet that we would have something like this, because in the material that we have studied on hedge funds, it essentially boils down to the fact that a hedge fund investor needs to be aware that if he's looking at any hedge fund index data, the performance is going to be overstated, and the riskiness of hedge funds is typically going to be understated. If you found this clip interesting and informative, please visit my website www.arifirfanullah.com. Here you will find a tremendous amount of useful material. Right here in the 2011 CFA video lecture series, you will find the entire level 1 curriculum for free, and most of the material here is still relevant. So this is worth looking at. The 2012 video lecture series covers both level 1 and level 2. These lectures are available for a fee. And finally, down here, financial management at IBA. Here you will find my lectures at IBA for a course on financial management. Plus you'll find lots of useful spreadsheets that can help you with financial modeling. So again, please visit www.arifirfanullah.com. Thank you.